Swayam Prabha. Digital India. Educated India.
Welcome dear students. Today we discuss one of the important topic of market intermediaries. I am Dr. Jaswant Saini, Associate Professor, Faculty of Law, MD, University Rohtak. I present this topic before you to develop your understanding about the functioning of market intermediaries. Market basically we consider financial market, and financial market is the combination of two markets, capital market and money market, and these intermediaries play their important role in strengthening of these markets, and particularly they are known as intermediaries of financial market, and in brief we say the market intermediaries. So, we as usual we start with the learning outcomes, and very first outcome to understand the role of market intermediaries in facilitating transactions between buyer and sellers. It means two persons here, one is buyer and another is seller. In between these two persons who provide the facility of transaction, those known as intermediaries, and they are bound to be maintain legal compliance and contributing to the overall functioning of financial market. So, financial market is the combination of various components, and market intermediaries is one of the component of this entire market. And the main function of this entire market to establish a sound economy or sound financial system. And second outcome of discussion to understand the legal framework and regulatory requirement that govern the activities of market intermediaries. So, what is the rules and regulation, and what is the application of these rules and regulation, and what procedure they follow in implementation of law, that we understand in this discussion. And third outcome to develop the understanding about various market intermediaries such as investment banks, brokers, financial advisors, understand their specific roles in corporate transaction, security trading and legal compliance. So, a huge list is available here before us of the market intermediaries, and we discuss one by one the specific role of each one here. And fourth outcome of this discussion is here to gain insights into how market intermediaries contribute to corporate governance. Corporate governance is the ultimate task of each and every economy. If there is a good governance in the country, it means country in the rightful direction and everyone smoothing in this entire functioning of the corporate sector. And basically GDP of any country reflect that the life standard of their peoples, and GDP reflected that the peoples are a developing countries in a developing stage, and if you are a developed country, the GDP reflected in such way. So, market intermediaries play a very important role to establish a sound economy in any country. So, we start the functioning of market intermediaries with their brief idea that who is a market intermediaries. Very first, market intermediaries may be individual, market intermediaries may be corporate entities, market intermediaries may be a institution. So, they are the every type of person may be act as market intermediaries, either that a natural born person, either that is a artificial person. So, the role of intermediaries established that they are the market intermediaries. They facilitate transaction and interaction between buyers and seller. It means intermediaries play the role of facilitator. They provide the facility between buyer and seller, and they fulfill the requirement as and when required on the side of buyers and sellers. They helping the buyers and sellers to fulfill their obligations. So, the legal regulations and compliance standards need to be fulfilled by these financial intermediaries. A market intermediary is working as a link between whom? They are the two parties, one ready to invest, second who require the money. Basically, we consider here those persons who save the money, the person in whose hand the money is available, those agree to invest, and who required the money, industries required the money. In between these two ends, who act as a bridge, they are known as market intermediaries. They work as a link, and I say here they work as a bridge between these two different ends. One end is here who have the money, second end is here who required the money. Basically, money in the hands of those who save the money, and second, money required by the industries. So, market intermediaries play the role of link. Market intermediaries working as bridges who provide the facility to those who have the money and who require the money. So, entire discussion based on this phenomena, who have the money, who require the money. In between these two ends, who play the role of bridge, they are intermediaries. So, very simple definition for a purpose of a layman. Common examples of market intermediaries are in legal context include investment bank, brokers, financial advisors and legal professionals who provide services related to corporate transactions. Not any other type of transactions we discuss in this discussion, we only discuss here corporate transactions which required at the end of market, and which market we are only discuss here financial market transactions. We not discuss fish market transaction, grain market transaction or other grocery market transaction. We only discuss here financial market transaction, and financial market, you know, that is the combination of two markets. One is known as capital market, another is known as money market. So, financial market is the combination of these two markets, and we are discuss the transactions in these two sectors, and the securities trading in this market and other financial activities which perform in this market we deals here. That is the point of discussion here on the part of intermediaries. We discuss the role of intermediaries in this context. So, importance of market intermediaries. Intermediaries play a crucial role in ensuring that business transactions are conducted lawfully and ethically. So, two things here. One, indicate every transaction must be lawful transaction. If any transaction leads to unlawful transaction, that is never protected by law. Law only protect those transactions which are legal in nature, which as per law, and ethically means not against the public policy, not against the business rules. So, very set formula is here. Your transaction must be legal and your transaction must be ethical. Ethical transactions required as per the demand of the society. You know it's very well, gambling is not accepted by the society. If any company established to run the gambling business, that is against the well settled principle of society, against the well settled principle of business law, because law never recognized the gambling. The legal framework surrounding market intermediaries varies across jurisdiction, but typically includes regulatory requirements to maintain transparency, protect investors and uphold the integrity of financial market. So, each and every discussion established with some specific purpose, with specific goals. And we discuss here the role of market intermediaries in various contexts, and very first context here, transparency. Can market intermediaries play their role to establish the transparency in the market? And second requirement is here, protect investors' interests. If the interest of investors protected by the market, then what's the role of intermediaries? Third one, uphold the integrity of financial market. So, there are the three roles, three tasks, three goals given to the market intermediaries. They help the market in such way, if they provide the information or they apply the legal requirements ethically, it means they are in the direction of maintain the transparency in the market. It means you are not enter into any transaction which is unlawful. So, you are supposed to be disclose each and every information for the benefit of entire market, either this information against yourself. So, protect investors' interest in the market, that is the foremost task of each and every activities, every market, every institution. You know it's very well, preamble of every act designed for establish the goal of such act. The preamble of SEBI Act 1992 define that Securities Exchange Board of India established to protect the interest of investors in securities market, and SEBI is the regulator of intermediaries also. So, ultimate task is here, intermediaries play their role in the market to establish the transparency and protect the interest of investors. And third important thing is here, integrity of financial market. If integrity of the financial market not establish, not exist, it means our investors not interested to apply their money in the market. So, that is the first task on the part of every country, they establish the faith of the investor in the market. If faith of the investors fluctuate in any way, they withdraw the huge amount from the market as per the policies, as per the news, as per the current situation, and that leads to volatility, and that leads to speculation in the market. So, financial market basically working on the faith of the investors or integrity of the market based on faith of the investors, and in this direction intermediaries play their important role to establish the faith of the investors in the market. And facilitation of transactions, they are the facilitator who provide the facilities of transaction. Market intermediaries such as investment banks and brokers facilitate various corporate transactions including mergers and acquisition, IPOs and stock transaction. So, various transaction here on the part of intermediaries, they play their role to materialize these transaction, and they practically apply their services in their transaction, and there is no meaning of any transaction without the role of intermediaries. In very opening words, we start with the same, who have the money, who require the money. Between these two ends, who play the role of link, who play the role of bridge, they are known as intermediaries. That may be individual, brokers are a individual person, and investment banks are corporate entities. So, in this direction, that's immaterial thing, either they are the individual or either they are the corporate entities. But important thing is here, we only consider here corporate transactions, and in this direction the mergers, amalgamation or acquisition or IPO or stock transactions, each and every type of transaction involved. In case of IPO, we require the role of underwriters, we require the role of merchant banker, we require the role of portfolio manager, we require the role of other institutions, means banks who accept the application on the behalf of company. So, various intermediaries we required for the success of market, for the success of IPO, FPO, right issue, bonus issue. So, each and every activity not performed without the role of intermediaries. And ultimate task is the here corporate governance. Corporate governance is the foremost task of every regulator, every institution or every country. If there is a good governance, that's resulted in sound financial market. If sound financial market, that leads to a good economy of the country. So, market intermediaries contribute a lot to maintaining and enhancing the standards of corporate governance. They act as a link between those who have the money and who require the money, and in between their activities known as good governance. And good governance is the very first task on the part of financial transaction. Any transaction without the corporate governance no any meaning in the business. So, regulatory compliance, what's the role of regulator, what's the role of intermediaries in this regulatory compliance? Market intermediaries are subject to regulatory oversight and must comply with laws and regulation governing their activities. Their compliance help maintain the integrity of financial market and nurturing confidence among participants. So, one thing is here, they play the role of helping hand in maintain the integrity of financial market and nurturing the confidence among participants. So, two things here, one is here, your role must be transparent and your activities must be ethical activities, and these activities for whom? To maintain the confidence among participants. Who are participants? Seller and buyers are the participants of the market, and if once a confidence established in the market, then money is available in the market. When money is available, it means we had that liquidity in the market, and if liquidity established in the market, it means we claim that the more and more money is available on the demand. So, liquidity if established in the market, that leads to a good transaction, that leads to a sound financial system in any country. So, liquidity means when you easily convert your financial asset into cash without waste of time and without waste of money. If you convert your asset into cash after some time and that is not converted into cash at the time of requirement, then no meaning of such conversion. If value waste in this entire process, then even there is no meaning of conversion of the same. So, legal compliance, every regulator here design or start their functioning with legal compliance. Intermediaries assist corporations in complying with legal requirements related to disclosure of information. So, being a student of business, being a student of law, you must ensure that in role of information in the market. Nowadays, when entire market converted into digital market or every transaction likely to be converted in e-transactions, lot of gateways are available for payment system, and every bank nowadays try to avoid the presence of their customers in their premises. They offer their services on internet basis, at your end basis. So, disclosure of information from the side of intermediaries are very important. If the information provided by the intermediaries are corrupt information or misleading information or not serve the fruitful purpose, then there is no any meaning of such information. They ensure that all material information is appropriately disclosed to relevant regulatory authorities. And one is regulatory authorities, second is shareholder and other stakeholders. So, three agencies involved in the functioning of intermediaries. First, regulatory authorities, and you know it's very well, there are two regulatory authorities, one is SEBI and second is RBI. RBI is the regulator of money market and SEBI is the regulator of capital market. So, these authorities known as regulatory authorities, and this is the duty on the part of intermediaries. They disclose the relevant information before the regulatory authority when they required or when they demand on the pattern of returns. On the regular interval, they demand the statements from your side as an intermediaries, and you provide the appropriate information. And information to shareholders and other stakeholders. Everyone if working on same level playing fields. It means if information available to all, then there is no any chance of corrupt practices we found in the transaction of financial market. So, three main functions of financial intermediaries include asset storage and loans and investments. They are the basic three functions performed by the intermediaries. It means they work as a custodian. Sometimes when we are talking about that, they are asset storage. They are working as depositories when they act on the behalf of depository participants, and they provide the loans when they act as financial institution, and they are the investment agency if they are act as a mutual fund. So, various role play by the financial intermediaries in the business transactions. So, they are the various companies or institution, they act as financial intermediaries, and there the huge list is available who act as an financial intermediaries in this direction. Very first we discuss here banks. Banks are scheduled commercial banks and non-scheduled commercial banks. RBI Act Schedule 2nd, if reflected the list, name of the banks reflected there in this such list, they are the scheduled commercial banks. If they are not incorporated in second schedule of RBI Act 1934, they are considered as non-scheduled banks. And banks play very important role in lending and borrowing money is simplified act of the banks. Otherwise, bank perform various functions, but for financial transactions we know that they are providing two facilities, one is lending and borrowing the money. And in these facilities they run their own expenses and they run the business of their institution, and they are the helping hand, they are the facilitators who provide the facility to the sellers and buyers. And second intermediaries here, stock exchanges. Stock exchanges here trading in share and other stock. Exchange products will be centralized and thus more easily accessible for buyer and seller. Stock exchanges are nothing, they are the facilitator who provide the facility of buying and selling. So, stock exchanges are designed to establish the liquidity in the market. If we want to judge the importance of any institution or importance of any services, we need to be judged as there is no any such institution or services. It means we delete the same for some moment, we easily find out the importance of these institutions. So, stock exchanges are the facilitator who provide the facility of selling and buying in the securities, and that leads to that's establish the liquidity in the market. That is the first function of the stock exchange, they maintain the liquidity in the market. So, they are also act as an intermediaries. And third one is known as pension funds. You know it's very well. After 1st April 2004, and after 1st April 2006, respectively in center and state, the pension in the hands of pension fund managers. New entrants in civil services, they are governed by new pension scheme. So pension funds are established by the government. In 2004, they established at central level, and in 2006, they established at the state levels. Now, and these pensioners funds apply their fund in the market, and the basic idea behind this one, a pensioners pay the pensions of current pensioners, future pensioners pay to whom? Current pensioners. That is the cycle, and pension fund nowadays apply in the market, and that's according to the government policies in which companies you apply the pension fund. That's a secondary thing. First thing is here, on the policies of government, these pension fund established by central government and state government to run smoothly this market. It means stock exchanges or you say financial market. Factoring clients receive money from the factoring provider for their outstanding receivables and thus liquidity. Factoring basically when the institution provide the credit facility for international transactions. That activities, that service is known as factoring, and this is also an important service which provided by intermediaries, and they charge the commission for the same. And insurance companies also play the role of intermediaries. For money insurance, they are arrange the money for the industries and apply the money in the industries for the benefit of entire stakeholder. Insurance companies protect their customers against certain risks. If you apply the money in individual capacity, then different risks are applicable in your investment. And if you apply through intermediaries, if intermediaries are involved in investment decisions, then the risk here contribute, and they have the huge team of experts, and they decide on the basis of their expertise the funds in the market. So types of market intermediaries, there are the various types here. Corporate law deals with various types of market intermediaries, and they play the distinct role in facilitating transaction, and they ensuring legal compliance and contributing to the overall functioning of financial market. So basic idea behind this discussion is here, what's the role of market intermediaries to establish the financial market in a sound financial market, and the financial transaction, how helpful to ensure these transactions are transparent, these transactions are ethical transactions. So that's the role of market intermediaries. They establish the confidence of investor in this market. And some common type of market intermediaries in the context of corporate law, here we discuss here. Out of these list, very first is here investment bank. Investment bank are the key players. It means they play the important role, so they are categorized as key players in corporate finance. When we are talking about the corporate finance, it means the both things here include, one is your investment, when you buy the shares you invest, and when you provide the loan, and when you provide the debentures, if you buy the debenture. So there are the various aspects of corporate finance. When you invest, you are also participate in finance. When you provide loan, you also participate in the finance. So investment banks play the important role in this direction. That's the key roles played by these banks, and they provide some other services also for the purpose of this market, and they provide the advisory service also, consultancy service also. For whom? For mergers and acquisitions. If two or more than two companies agree to come under one flag, that activity may be merger or amalgamation. Acquisition means when one company acquires the control of another company. And in this direction, the advisory service is provided by whom? advisory service provided by intermediaries. The role of intermediaries here start when any activity comes into the mind of board of directors, and if they wants to implement this idea into practical, they take the help of intermediaries. And a huge list is available of intermediaries, and out of these list, which one suitable in your context, that's a service provider or the banks or the institution, that according to circumstances you take the help of those. And another service is here underwriting services. Underwriting services basically relates to when company decide to issue the IPO. At that time SEBI guidelines insist that no any company allowed to allot the shares unless they obtain the 90% subscription. And these persons, underwriters, may be a group of institution or maybe financial institution or maybe scheduled bank. They may be act as an underwriter if they take the responsibility to take such shares who complete the requirement of SEBI, who fulfill the 90% subscription criteria which laid down by SEBI. Those persons who gave this undertaking, those known as underwriters, and they charge the commission for the same, and this commission is known as underwriting commission. So nowadays in present scenario, it is an essential, first before issue the shares, before the allotment, company must ensure that there is a 90% subscription criteria must be fulfilled here. If not fulfilled, then this responsibility on the shoulder of underwriters. They take the responsibility to subscribe the issue up to that extent, and they buy from their own funds up to that extent which required as per the criteria laid down by SEBI. And these securities offering including IPO and facilitate capital raising. So various services provided by service providers here, and those known as intermediaries, and there may be advisory service, may be consultancy service, may be undertaking service as an underwriters. So various services provided by these intermediaries according to demand of the circumstances, or according to the demand of market, or according to the demand of who avail the services. Brokers and dealers, that's another service here on the part of intermediaries here. Brokers and dealers act as intermediaries in securities transaction. Broker execute trades on behalf of clients, while dealers buy and sell securities on their own account. So very first difference here, if you act as a broker, it means you act on the direction of clients, you act on the behalf of client. But if you are the dealers, you direct deals through your own account. So dealers deals through their own account and brokers act on the behalf of clients. That's the major difference between these two intermediaries here. So regulatory framework for intermediaries here. Financial advisors provide advice various financial matters including merger, acquisition and restructuring. Restructuring of company's capital is the important task when company required at their end. So restructure sometime on the requirement of business demand, or sometime as per the government policies we restructure our share capital. Generally, this is the outcome of the decisions taken by majority of the shareholders, or the substantial shareholders if take the decision, then that's the outcome of their decision, the restructure of share capital. They assist companies in making strategy, financial decision, taking into account legal implications. What decisions you take, their implications also attach with the same. the consequences of your decision also attached with the same. So companies are not divert, not shrink from those decisions or those consequences which they decided. So once you take any decision, consequences also attach with the same. So regulatory authorities such as SEC is applicable, Securities and Exchange Commission in the United States, the Financial Conduct Authority FCA in the United Kingdom, and SEBI in our Indian scenario. In our India, we know the regulatory authority of this financial market is here SEBI, and this authority regulate corporate activities and ensure they comply the law and regulation. Regulatory authority work in two direction. Very first direction, to issue the direction, to issue the guidelines as per the circumstances. Second, these authorities ensure that legal compliance. If two performance is there, it means regulatory authority working proper in this direction. So the various authorities working for various sectors here. For insurance sector, IRDA is working. For capital market, SEBI is working. For money market, RBI is working. So there the regulatory framework and regulatory compliance required on the part of regulatory authorities. And regulatory framework here for market intermediaries in India is primarily seen by SEBI, which is the regulatory body for the security market in the country. Some key components for regulatory framework we discuss here. The SEBI intermediaries regulation. SEBI has issued specific regulation for various type of intermediaries and outline the conditions for registration, conduct. They are not supposed to be act as intermediaries unless they obtain the license from SEBI. Under section 12 of the SEBI Act 1992, SEBI is the regulating authority of intermediaries, and every intermediaries who ready to act in this financial market, they need to be first obtain the license from SEBI under section 12. So registration of these intermediaries in the hands of SEBI, their conduct also in the hands of SEBI, and they are bound to comply the rules and regulation which laid down by SEBI, and other regulatory requirement also in the hands of SEBI. So SEBI is considered as regulator of the intermediaries. And another aspect here in this one, KYC, know your customer, and AML, anti-money laundering guidelines. These two guidelines establish that they are the smooth functioning of financial market. If transactions fulfill by these two parameters, it means companies are working properly in their field, and regulators also working in their field if they ensure that these two guidelines must be complied. Market intermediaries are required to adhere to strict KYC and AML guidelines to prevent money laundering and ensure the integrity of the financial system. And presently what's happened in the market, due to not follow the rules of KYC, Paytm Bank asked to close their business by RBI. That is the current example here in our market scenario. And second is here anti-money laundering guidelines. Money Laundering Act is the important, that's known as PMLA Act, and various activities checked by ED, Enforcement Directorate, where there is an involvement of foreign currencies are there, then ED start their functioning. And nowadays in India, the ED play very important role for ensure that all transaction must be in a strict compliance rule. Every transaction as per the law there. So compliance and reporting requirements. Market intermediaries are obligated to comply with periodic reporting requirements, providing information on their operation, financial health and compliance with regulatory norms. So on regular intervals, when regulators demand the information, in the form of statement, in the form of return. Purpose behind these information to ensure that you comply the rules and regulation, you comply the guidelines. So the main purpose behind this one is that you must follow the rules and regulation. Market Infrastructure Institution MIIS also working under the purview of SEBI. SEBI also regulates market infrastructure institution such as stock exchanges. Stock exchanges, at once a time 27 stock exchanges were working in India. Nowadays only 3 exchanges are working in India, rest of the exchange suspend their business. And these are known as Bombay Stock Exchange, National Stock Exchange and over the counter exchange of India. So depositories, 2 depositories working in India, one is NDSL, another is CDSL, National Depository Service Limited and Central Depository Service Limited, and they ensure the smooth functioning of security market. So market infrastructure institutions which under the control of SEBI ensure that they are working properly in their particular arena, particular field. So the market infrastructure institution primarily consists of the following 3 entities from the stock market. Very first, stock exchange, second one, clearing house or clearing corporations, and third one, depositories. They provide the basic infrastructure services. They are the facilitator who provide the services on their end, and they are under the control of SEBI, and SEBI is also under the control of central government. So ultimately they are the control on financial market of the central government, and central government is the guardian of public money. So that is the first duty on the part of central government. They protect the interest of investors in security market, and for this particular purpose they appoint agency. That agency is known as SEBI, Security Exchange Board of India. So compliance requirement, here market intermediaries in India are subject to various compliance requirement imposed by SEBI, the regulatory authority overseeing the security market. Very first compliance is here licensing. So registration and licensing, market intermediaries such as stockbrokers, investment advisors, merchant bankers and other entities must obtain registration or license from the SEBI under section 12 of the SEBI Act 1992. Unless you obtain the license, you are not act in the financial market. Your activities are illegal activities. License is the primary condition. Once you obtain the license, that ensure that you have the sufficient infrastructure to meet the obligation of the facilities you take responsibility to provide. So compliance officer, market intermediaries are required to appoint a compliance officer. So every market intermediaries must ensure that they comply the rules and regulation, and for this particular purpose you establish a officer or you appoint a officer, you depute a officer, and this officer known as compliance officer who is responsible for ensuring compliance with regulatory requirements. The compliance officers serve as a liaison officer. Liaison officer, you may be say compliance officer, both are the same term, who maintain the consonance with the rules and regulation along with direction issued by the regulator. In case of companies, every company's secretary in the public limited company is considered as compliance officer, who certified that all rules and regulation here comply. So that's also known as liaison officer, who maintain the liasoning. Liasoning between whom? Liasoning between rules and regulation and the direction or the guidelines issued by the regulator. In between these, who maintain the consonance, who maintain the relation, those are known as liaison officer or compliance officer. So internal control and audit. Intermediaries must establish and maintain internal controls to ensure the accuracy of their operation. accuracy of their functioning. They are also subject to periodic audits to assess compliance and financial soundness. So, accounts and audit are two components. Accounts always maintained by company itself, and audit always made by independent authority, independent person. So, nowadays in universities, in academic institutions also, they conduct on annual basis academic audit. Academic audit certified that you comply the rules and regulation. You maintain the decorum of rules and regulation, and you follow the rules and regulation as required by regulatory authority. So, investor grievance redressal mechanism, SEBI places a strong emphasis on investor protection. Why? Because SEBI is established with this particular object. The preamble of SEBI Act 1992 clearly defined that SEBI established with this purpose to protect the interest of investor in security market, and he act for the development of security market, and that is the first task which settled by the preamble of the SEBI Act. So, market intermediaries are required to develop the mechanism. It means every market intermediaries must develop the mechanism for addressing investor grievances promptly or very quickly. If you address the grievances of investors, it means that's very helpful to establish the faith of investor in the market. And insider trading regulation issued by the SEBI intermediaries and their employees are required to comply with regulation related to insider trading. The key managerial personnels must ensure that they follow the code of conduct as well as guidelines, directions issued by the regulator to control the insider trading. Insider trading basically, as a layman I highlight here, on the basis of unpublished price sensitive information, if someone gain or avoid the loss, this activity is known as insider trading. And insider trading is totally banned in the corporate structure, in the corporate activities, in the business activities, in financial market, in transactions. That's totally banned, because that's against the well settled principle of law is that parties must be on same level playing field. If one party have the information and other party not have the information, it means that's not a same level playing field. If there is no any same level playing field, there may be chance of corruptions here. So, insider trading leads to be this corruption. So, legal responsibilities and obligation. Market intermediaries in India are subject to certain legal responsibilities and obligation outlined by the SEBI, which regulate the security market in the country. These legal responsibilities are designed to ensure the integrity of the financial system and protect the investors and maintain fair and transparent market. Once this perception is established in the market, market is fair and transparent, then everyone ready to invest their savings in the market. Public only hesitate to invest in the market when they listen, when they find out the cases of corrupt practices, when they find out the cases of insider trading. Once the faith of the investors established, then there is no problem of money in the market. The investment easily available on the demand, loans are available on the demand, and profitable ventures are working with a huge capital. So, compliance with SEBI regulations, market intermediaries must comply with the regulation and guidelines issued by SEBI, which govern their conduct, registration and operational aspects. So, three aspects here. One is relates to conduct, second relates to registration, third relates to operational, means procedural aspect here. intermediaries are bound to comply with SEBI Intermediaries Regulation 2008. This is amounts to Bible. When SEBI issue the guideline, that guidelines treated as the binding force. That's the rules which everyone need to be bound here to follow the same. So SEBI Intermediaries Regulation 2008 are very important to conduct the functioning and registration aspects and operational aspects of intermediaries, and intermediaries are also bound to be follow the code of conduct. Code of conduct which emphasize ethical behavior, fair dealing and integrity in the transaction with clients, other market participants and general public. And every intermediaries must provide this code of conduct on their website. And code of conduct if you follow, no doubt your goodwill established properly in the market. So code of conduct is the certain set rules which require to be followed as per public policy, as per the demand of the business. So disclosure of information, intermediaries are obligated to disclose material information to their clients, including risk associated with financial products or service. Transparent disclosure is the vital in helping clients make informed investment decisions. So from the entire discussion we comes on one conclusion, that if a transparent or fair information is available in the market, that's very, very helpful to establish the faith of the people, faith of the investor in the market. And that's also governed by fiduciary duty. Certain intermediaries such as investment advisors owe a fiduciary duty towards their clients. This duty requires intermediaries to act in the best interest of their clients, avoiding conflicts of interest and providing advice that is suitable for the client's financial situation and goals. The biggest advantages of financial intermediaries is that they create a central market where financial transaction can be conducted. By scaling financial intermediaries appropriately, bureaucracy is kept to a minimum and experts take care of advising clients and processing transaction. This in turn is cost efficient for the client. It means involvement of the bureaucracy if minimized, it means the market governed by market forces. If market in the hands of market forces and no any role of the bureaucracy, then this market is helpful to establish a sound economy in the country. And regulatory reporting is also play very important role in this direction. Intermediaries must submit periodic reports to their regulators, and for this market SEBI is the regulator that's providing information on their financial health, compliance with regulatory norms and other relevant details. Cooperation with regulatory authorities, intermediaries are required to cooperate with the regulatory authorities. If they help to the regulatory authorities, it means there is the good relation established between intermediaries and regulatory authorities, and this good relation is very helpful to maintain the sound economy, sound financial system in country. So relevant case laws are here which relates to the same. Security and Exchange Board of India versus Sahara India Real Estate Corporation Limited. This case decided in the year of 2012 by the Supreme Court, and this matter relates to legal issues related of the issuance of optionally fully convertible debentures by Sahara Group, and it raised question about the regulatory jurisdiction of SEBI over such instruments and the need for proper disclosure for market intermediaries. In this case, Supreme Court held that SEBI is the ultimate authority to deal such issues. Ketan Parekh scam in 2001, this case also highlight the concerns regarding market manipulation and insider trading, and responsibility of market intermediaries is upholding market integrity. So in this case also court held that that's the duty of the intermediaries to establish their faith in the market. Amit Kumar Modi versus Security Exchange Board of India 2019. In this case, SEBI penalized a stock broker for executing a trade without client authorization. It means client never authorized to this institution and they act without authorization. That's also fixed the responsibility of market intermediaries in this case. Satyam computer fraud case in 2009. This case also raised related to the role of auditors, financial advisor and market intermediaries to ensuring accurate financial disclosure. So, this is the important cases here. Corporate governance and market intermediaries, they establish the relation between corporate governance and market intermediaries. Regulation and governance is very important role, and market intermediaries sometimes play the role of advisory. They play the role of enhancing transparency and disclosure for good governance, and ethics in market intermediaries very important for fair dealing and transparency and confidentiality of the investors. And we summarize with some here bullet points here. These are in the summary. Market intermediaries play an important role in upholding corporate governance standards. So, standards maintain with the role of intermediaries. If intermediaries not play their role, then we fail to maintain the standard. These intermediaries play the very important role to promote transparency in the market, and various intermediaries like bank, broker, financial advisor under the control of SEBI, and they are bound to be follow the ethical rules, means code of conduct. Market intermediaries contribute to corporate governance, that is the ultimate task of the every economy, every country. If good governance is there, it means good market is there. Thank you.
Hello and welcome to this piece of literary snippet. We usually know William Shakespeare as the most revered figure in the history of English literature. But we often tend to forget that he has also been one of the most hated figures in literature. And here I am not talking only about those boys and girls who have to memorize long sections from Macbeth or King Lear or Julius Caesar before they can go and sit for their school or college exams. But I am also talking about people who are themselves quite famous authors. Tolstoy, for instance, considered the writings of Shakespeare to be, and I quote, crude, immoral, vulgar and senseless. George Bernard Shaw absolutely loathed Shakespeare, as he did Homer. But perhaps no other criticism about Shakespeare is more damaging than the one which says that Shakespeare is a marvelous storyteller, provided someone has told him the story earlier. Now, this piece of criticism is particularly damaging because it is true. None of Shakespeare's plays contain any original story whatsoever. They are all written using pre-existing materials, pre-existing stories. Now, does that diminish the stature of Shakespeare as a dramatist? Well, I'll leave that for you to decide. See you in the next episode of Literary Snippets.